Imagine this. You're losing potentially hundreds of thousands of dollars, maybe delaying your financial freedom by like a decade or more. And it's all because of one hidden choice in your investments.
It sounds dramatic, but it happens all the time.
It really does.
Yeah.
So today on the deep dive, we're going to cut through, all the hype around the different fund types. We're talking index funds, mutual funds, ETFs, even hedge funds. We've looked at the research and we're going to distill it down to figure out which ones actually build serious wealth, and maybe more importantly, which ones might be quietly draining your future.
And it's a mistake, like you said, that most people make without even realizing it. They just follow default 401k options or maybe get some casual advice from a friend.
Right.
But this isn't just a technical finance jargon we're talking about. It's genuinely the difference between retiring early, maybe having real options, or, grinding away until you're 70.
Yeah.
It's that line between real financial independence and just watching your savings kind of get eaten away by inflation.
You're absolutely right. And that's exactly what we're digging into today. Because the fund you choose, it directly determines how much of your money goes to fees versus how much actually compounds and grows for you.
Right.
We're talking about a fund charging maybe 0.03% a year versus another charging over 2%. That sounds small, right? But over 30 years.
Oh, it's huge.
It could quietly cost you 6 figures in lost growth. Hundreds of thousands gone. Just vanished.
And that really drives home the bigger picture, doesn't it? It also affects, how much control you have over your investments, how fast your wealth can realistically grow.
And safety too, right? During downturns.
Exactly. And even your own behavior as an investor. Think about it. Index funds are passive, low maintenance. You can kind of set them and forget them. But some of these more complex options, like, say, hedge funds, they might make you feel like you're doing something sophisticated, something elite.
Even if the results don't match up.
Precisely. And when things get confusing, that's often when people panic and pull their money out at the absolute worst time.
Okay, so our promise today is this. By the end of this deep dive, you're going to know which fund type builds wealth the fastest, and that's net of fees and risk, and which ones you should probably steer clear of.
Yeah.
This isn't theory. It's about your real money, your real timeline, and ultimately your real freedom.
Right.
So let's unpack this.
Okay, so first things first, let's just make sure we're all on the same page about what these 4 things actually are. A lot of people kind of use the terms interchangeably.
Guilty. Used to do that.
Right. But investing blind like that, it's basically gambling. It's not wealth building. So our goal here is just to break them down quickly, clearly, without getting lost in the weeds.
That was good. Let's start with maybe the quiet champion.
Index funds.
Yeah, the chill genius, as some might call it. Basically, an index fund is a type of mutual fund, or ETF. We'll get to those. That just tracks a specific market index. Think the S&P 500.
Right, the 500 biggest U.S. companies.
Exactly. There's no fund manager trying to make brilliant stock picks. It just aims to mirror the performance of that index. So no flashy moves, just steady does it.
Pretty much. And their power lies in, well, 2 main things. Ultra low fees, some are down around 0.02%, which is practically nothing, and that passive strategy. They're not trying to beat the market, they're just trying to be the market.
And the data backs this up, right? Decades of it.
Overwhelmingly. Decades of data show they consistently outperform most active investors over the long haul. Even Warren Buffett famously advised his heirs to put 90% of their inheritance into a simple S&P 500 index fund.
Wow. That says a lot about simplicity, doesn't it?
It really does. Simplicity often wins. Okay, next up, ETFs. Exchange-traded funds.
The cool, flexible cousin.
Yeah, that's a good way to put it. They're similar to index funds in that many of them do track indexes, but the key difference is you can buy and sell them throughout the trading day, just like you would a stock.
Ah, okay, so more flexibility than a traditional mutual fund, which usually prices once a day.
Exactly. They offer benefits like tax efficiency, often low cost, though you need to check, and that liquidity, that ability to trade easily, great if you want that flexibility.
But there's a catch.
Well, yeah, not all ETFs are the same. Some are super niche, maybe focused on one tiny sector, or they might use leverage, making them riskier. So you really have to, read the fine print, understand what's actually in the ETF.
Got it. Okay, number 3, mutual funds. This one feels a bit more traditional.
It is. And it gets a little tricky because there are really 2 main types. Passively managed, which are basically index funds in a mutual fund wrapper.
Like the ones we just talked about.
You're right.
Wow.
And then there are actively managed mutual funds. These are the ones run by a fund manager or a team, actively trying to beat the market. They're picking stocks, timing trades.
Trying to be the hero.
Trying to be the hero, exactly. And they charge you for that effort, usually hefty fees, often 1% to 2% per year.
And the punchline?
The punchline is, most of them don't actually beat the market, especially after you subtract those fees. You often end up paying a lot more for just average or even below average performance.
Ouch. So you pay for effort, not necessarily results.
That's often the case, which is why, so many investors nowadays are shifting towards those passive index-based mutual funds or just using ETFs instead.
Makes sense.
Oh.
Okay, last one. Hedge funds. These sound exclusive and, frankly, a bit mysterious.
They are. This is the big money, high stakes world. Generally, they're only open to accredited investors.
Which means?
Usually people with a high net worth, like millionaires or institutions like pension funds or endowments. They use really complex strategies, things like shorting stocks, using derivatives, leverage, often making quite exotic high-risk bets.
And the promise is huge returns, right?
That's the pitch. Outsized returns, uncorrelated with the market. But the reality? Often very different. The fees are usually insane, typically something like 2 and 20.
2 and 20?
Yeah, 2% of the assets they manage each year plus 20% of any profits they generate.
Wow. That's a lot.
It's a huge hurdle to overcome. And the data shows many hedge funds actually don't consistently outperform simple, low-cost index funds, especially after those massive fees are taken out. Plus, they're often very opaque. You don't always know what they're investing in.
So definitely not a wealth builder for your average person.
Absolutely not. They're more like high-risk chess games for the ultra-wealthy, not your foundational investment strategy.
Okay, that's a great breakdown. We know the players now. But here's the core question, right? The whole point of this deep dive. Which of these actually helps you build wealth? Reliably, safely, and, fast enough to make a real difference in your life.
Right. Because like we said, not all funds are created equal. Some are great wealth builders. Others just kind of quietly siphon your money away with fees.
So where should people focus?
Well, if you're looking for a reliable playbook for wealth building, index funds really have to be a cornerstone. I know, they sound boring. They're passive.
Not very exciting.
Not exciting at all. But here's the kicker. They consistently outperform something like 80% of those actively managed funds over the long term.
80%. Why is that?
It's because they avoid big pitfalls. No high management fees eating away at returns. No manager trying to time the market, which is incredibly hard to do consistently. No guessing games about which stock is next. They just give you that slow, steady exposure to the whole market or a big chunk of it.
And then compounding takes over.
Exactly. Connect that steady exposure to the power of compounding over 10, 20, 30 years.
Yep.
These funds don't just grow, they multiply. We mentioned that example earlier. $10,000 in an S&P 500 index fund back in 2000 would be over $47,000 now. And that's with basically no trading, no stress, just results. That is wealth building. It's the quiet antidote to those financial delays we talked about at the start.
Okay, so index funds are the reliable workhorse. What about ETFs? Can they build wealth too?
Definitely. ETFs can be really powerful wealth builders, especially the broad market, low-cost ones. Think of a total U.S. stock market ETF like VTI, which gives you a tiny piece of thousands of U.S. companies.
So similar benefits to index funds, but with that trading flexibility.
Right. Low fees, great diversification. Plus, you can buy and sell them anytime the market's open, and many have easy dividend reinvestment options to boost that compounding.
But you mentioned a but earlier.
Yes, and it's crucial. Themed ETFs, the ones focused on AI stocks or metaverse breakthroughs or whatever the hot trend is.
Yeah, you see ads for those.
They often come with higher risks, usually higher fees too, and frankly, less proven long-term returns. It's more speculative.
Yeah.
So yes, ETFs can build wealth, but you've got to pick the right ones, generally the broad, boring ones.
Okay, that makes sense. Choose broad exposure over chasing trends. Now, what about actively managed mutual funds? You painted a slightly less rosy picture there.
Yeah, and here's the maybe harsh truth. For the average investor, most actively managed mutual funds are not great wealth builders. The main culprit, those fees.
The 1-2% you mentioned.
Exactly. They charge that fee even if their performance is just average or worse. And that fee might sound small, just 1% or 1.5%.
But over 30 years.
It's devastating. Let's use that concrete example again. Say you have $50,000. One fund earns 8% with a tiny 0.05% fee, like an index fund. Another earns maybe 7%, slightly less, but charges a 1.5% fee.
Got it.
Over 30 years, that seemingly small fee difference, it costs you over $100,000 in lost growth.
Wow, over $100,000 just gone to fees.
Gone. That's exactly how those fees secretly siphon away your future wealth, just like we warned about. It's not wealth building, it's slow financial erosion.
Okay, point taken on active mutual funds. Be very, very careful with fees. And hedge funds. We already established they're not for most people, but are they wealth builders for the rich?
Honestly, even for the rich, they're often more of an illusion of wealth building or maybe a diversification play rather than the core engine. Remember, you generally need a net worth of several $million just to get in the door.
Right, the accredited investor rule.
And even if you qualify, study after study shows that the average hedge fund actually underperforms the market after accounting for those massive 2 and 20 fees.
So even the wealthy might be better off in index funds.
For the bulk of their money, often yes. Hedge funds involve high risk, high complexity, often low transparency. It's just not a reliable formula for steady wealth accumulation for most people, even the wealthy. It's more like that casino with velvet chairs we talked about.
So boiling it all down.
Yeah.
The bottom line on which funds actually build wealth reliably seems pretty clear.
Yeah, the data consistently points in one direction. Low-cost, diversified index funds and their close cousins, broad market ETFs. They might not be sexy, they're not exciting.
But they work.
They work. And over the long haul, they tend to win.
Now, here's something that always fascinates me. You hear so much hype from financial influencers, right? About the next hot stocks, the complex strategy. But what do the really wealthy actually do with their money?
Ah, that's a great question. And the answer is often surprisingly boring.
Boring. Not what you see on Instagram.
Definitely not. When you peel back the curtain, look at actual long-term portfolio data, not just flashy claims, you find a pattern that's remarkably understated. It's generally not built on exotic hedge funds or frantic day trading or jumping on the latest themed ETF.
But what is it built on?
Mostly low-cost index funds,
Yeah.
tax-advantaged ETFs, and just relentless, patient, long-term compounding.
You mentioned Warren Buffett earlier.
He's the perfect example, arguably one of the greatest investors ever. And his instruction for his family's inheritance put 90% of it in a dead simple S&P 500 index fund.
90%. Not some secret Berkshire Hathaway strategy.
Nope. Just the basic passive index fund. Why? Because he knows better than almost anyone that consistently beating the market is incredibly hard, almost impossible long term. He knows high fees are poison to returns, and he knows that simplicity scales beautifully.
And it's not just Buffett, right? There's broader data.
Absolutely. That 2022 Fidelity study we touched on, it looked at high net worth portfolios that consistently grew over a decade or more. What did they find? Typically, 60% to 80% of those successful portfolios were parked in index tracking funds. A mix of mutual funds and ETFs for flexibility, sure, but the core was passive indexing. And crucially, very little trading, minimal turnover.
So they're not constantly buying and selling.
Generally not. They're playing chess, not checkers. Slowly, patiently, letting compounding do the heavy lifting.
Okay, but surely some wealthy people use hedge funds. We talked about those.
They do, yes, but how they use them is key. For most, it's not the core of their wealth strategy. It's more like a small satellite position, maybe 5% or 10% of their portfolio. A side bet for potentially high returns, yes, but also high risk. Something they can afford to lose, frankly.
So it's not where the bulk of their serious money is growing.
Exactly. The vast majority of their wealth usually sits quietly in those boring, diversified funds, just growing year after year. It's like owning that goose that lays the golden eggs. You just let it keep laying.
It sounds like the real secret of the wealthy isn't some magic formula, but discipline and structure.
That's a huge part of it. They focus less on finding the next big thing and more on owning the right assets, like broad market exposure and the right vehicles, like low-cost tax-efficient funds. They max out their tax-advantaged accounts. They reinvest dividends automatically. They set up regular contributions.
And they don't panic sell.
Critically, they try to avoid emotional decisions. They stick to the plan. And often, that plan is built on those boring index and ETF strategies. It's about disciplined, long-term ownership.
So the takeaway for our listeners is, if you want to invest like the wealthy actually do, focus on those low-fee index funds and ETFs. Invest consistently, try to tune out the noise and the hype.
And trust the long-term data. It's less exciting, maybe, but far more effective.
All right, let's talk about some of the things that hold people back, those common investing myths, the sort of sneaky lies that sound plausible but actually sabotage your progress.
Yeah, these are important to debunk because they keep people on the sidelines or making poor choices. They hear them from friends, maybe see them online.
Let's hit the first one. Myth number one, only rich people use index funds. I hear variations of this sometimes, like index funds are too complex or only for people who already have millions.
Right. It's completely backward. Index funds are arguably the most democratic investment tool out there. They were practically designed for people starting from scratch, trying to build wealth over time.
Whether you have $100 or $100,000.
Exactly. They're the foundation of countless retirement plans, 401k, IRAs. They let you, with very little money, buy a piece of the biggest, most successful companies in the world at almost zero cost. It's not about being rich to use them. It's about getting rich slowly and steadily by using them.
Okay, myth busted. What's next? Myth number two, you need to beat the market. This feels like a big one, tied to ego, maybe.
It is a big one, and honestly, it's kind of toxic. This idea that success means outsmarting everyone else, picking winners. It sounds exciting, right?
Sure.
But the reality, as we've discussed, is that most professionals, even highly paid hedge fund managers with massive resources, cannot consistently beat the market average after you account for their fees and trading costs.
So trying to beat it is usually a losing game.
For most people, yes. You know what consistently does outperform most active traders and fund managers over time? Simply owning the market itself through a broad, low-cost index fund. Like Buffett says, don't try to beat the market, own it. The real edge isn't in heroic stock picking, it's in consistency and low costs.
Own the haystack, don't look for the needle.
Exactly. Okay, myth number 3. ETFs are risky and complicated. People hear exchange-traded fund and maybe get intimidated. Yeah, I think the name sounds technical, and there are thousands of different ETFs, which can be confusing. But at their core, most broad market ETFs are just really flexible packages of investments.
Often tracking the same indexes as mutual funds.
Precisely. They often track the S&P 500 or the total stock market, just like index mutual funds. But they usually come with lower fees, better tax efficiency in taxable accounts, and more transparency. You generally know exactly what you own.
So the ETF structure itself isn't the risk?
Not inherently, no. The risk comes from misusing them, like chasing those narrow, speculative-themed ETFs we talked about, or trying to day trade them. But a simple, broad market ETF, it's generally no more risky than its mutual fund equivalent, and often cheaper and more efficient.
Good clarification. All right, last one. Myth number 4. If you're not rich yet, just save. This sounds responsible, right? Save your money.
It sounds responsible, but it's subtly dangerous advice if taken literally as just save. Yes, saving money is absolutely crucial. You need an emergency fund, you need savings habits, but saving alone will not build significant wealth over the long term.
Why not?
Inflation. Cash sitting in a savings account, even a high-yield one, is likely losing purchasing power over time as the cost of living goes up. If your savings earn 1% or 2% or even 4% and inflation is 3% or 4% or more, you're actually going backward financially.
So saving is necessary but not sufficient.
Exactly. Wealth isn't built just by hoarding cash. It's built by owning assets that have the potential to grow faster than inflation. Things like stocks, through funds, real estate, maybe owning a business. The myth of just save more keeps people stuck in a low-return trap, thinking they're being safe when they're actually falling behind.
So the big picture truth seems to be, wealth is built using simple, proven tools, maintaining a long-term mindset, and taking consistent action, not getting paralyzed by myths or chasing complexity.
Couldn't have said it better myself.
Okay, so we've defined the funds, we've seen what the wealthy actually do, we've busted some myths. Now for the payoffs. Let's get practical. Which fund should you, listening right now, actually choose for your goals?
Right. And the good news here is, despite all the options and jargon, it doesn't need to be super complicated. You don't need a finance degree for this.
Thank goodness.
Really, for probably 90% of people, the focus shouldn't be on finding some exotic, complex portfolio. It should be on clarity, simplicity, and just getting a strategy in place that works and that you can stick with.
So let's break it down, step by step. What's step 1?
Step 1, if you're just getting started, or maybe you're building up your investing habit, or you just want the simplest, most proven path, choose index funds.
The boring champion again.
The boring, reliable champion. They are your absolute best friend when starting out. Why? Lowest costs, instant diversification, and decades of proof that they outperform most active attempts to beat the market. Your goal here isn't fancy, it's just to own the market.
Any specific examples people could look at?
Sure. Classic starting points are things like a total stock market index fund. Vanguard's VTI is the ETF version. VTSAX is the mutual fund, which aims to own basically every publicly traded U.S. stock. Or an S&P 500 index fund like VOO for the ETF, VFIX for the mutual fund. You're buying tiny slices of America's biggest companies without any guesswork. Simple, effective.
Okay, index funds is the foundation. What's step 2, maybe for someone who wants a bit more control?
Step 2. If you want more flexibility, then consider ETFs. Broad market ETFs, specifically, they function very much like index funds, often tracking the same indexes.
But with that ability to trade during the day.
Right. Trade during market hours, maybe target specific broad sectors if you have a reason, though be careful there, and potentially get better tax efficiency if you're investing outside of a retirement account. So if you like being a bit more hands-on, broad ETFs give you that room without necessarily adding huge risk.
But stick to the diversified ones, not the niche trend.
Absolutely. Avoid the hype, stick with broad exposure.
Got it. Step 3, what about mutual funds? Especially those active ones.
Step 3 is be cautious with mutual funds, particularly the actively managed ones. Now, not all are bad. Some passive index mutual funds are excellent, especially inside a 401k where they might be your best low-cost option.
So check what's actually available in your retirement plan.
Definitely. If you have mutual funds in your 401k, look closely. What's the expense ratio? That's the fee. Is it low, like under 0.2%, or high, like over 1%? How has it performed over the last 5 or 10 years compared to its benchmark index? Is it actively managed, or is it a passive index fund?
And if it's an expensive, underperforming active fund.
See if there's a low-cost index fund alternative available within your plan. If there is, switching could save you a lot of money over time. Outside of a 401k, you often have more choices, so ETFs or direct index mutual funds are usually preferable to expensive active funds.
Okay, caution on mutual fund fees. And finally, step 4, hedge funds.
Step 4, hedge funds. For probably 99.9% of listeners, just forget about them.
That's straightforward.
Seriously, let's be real. Most of us don't have access anyway because of the accredited investor rules. And even if you did, as we discussed, they're super expensive, complex, opaque, and the data shows they often don't even beat simple index funds after fees.
So, not a path to wealth for basically anyone listening.
Not a foundational path, no. It's an optional high-risk satellite for the ultra-wealthy, if anything. Just skip it. Focus on the core.
Okay, let's recap that core message then. If you want to build wealth,
index funds are your foundation. Solid, reliable, low cost. ETFs offer flexibility, especially broad market ones, often with low cost too. Mutual funds. Be very careful with fees, especially active ones. Prefer index versions. Hedge funds. Not relevant for most people's wealth building journey.
And the underlying principles.
Simplicity wins. Fees really matter. Minimize them ruthlessly. And maybe the most important rule of all. Time in the market beats trying to time the market every single time.
Wow. Okay, we've covered a ton of ground here. If you've stuck with us, you've genuinely learned more in this deep dive than many people learn in years of investing. Maybe ever. You're now armed with the knowledge, the real knowledge, not the hype, to make choices that could absolutely change the trajectory of your wealth, your retirement, your financial freedom.
Yeah, the understanding is there now.
But here's the real question, isn't it? What are you going to do with this knowledge? Because the biggest threat to your financial future, at the end of the day, it isn't picking the slightly wrong fund.
Yeah.
It's doing nothing at all. It's letting inertia win.
Absolutely. That paralysis is the real dream killer. But you, listening right now, you stuck through this whole deep dive. You're clearly serious. You want more than just surface level advice. You want that real freedom. And you seem willing to put in the thought to earn it.
So what's the first step? Keep it simple.
Keep it super simple. Don't overthink it into inaction. Pick a good, low-cost, broad market index fund or ETF. Set up automatic contributions. Even small amounts regularly add up hugely over time. And then
let it ride.
Give it time. Let compounding work its magic. You don't need to be perfect on day one. You just need to begin. Start the process.
That feels empowering. Just start. And maybe you remember that final, powerful truth, the one that underpins all successful long-term investing.
Say it again.
It's not about timing the market. It's about time in the market.
That's the core of it.
Now go build. You've got this.